Hey everyone, and welcome back to the channel. Today, we're jumping into a topic that could save you a serious amount of money: refinancing your mortgage. Specifically, we're looking ahead to 2026. Why 2026? Well, a lot of folks who bought homes during the low-rate frenzy of 2020 and 2021 might be seeing their initial fixed-rate periods end around then. Plus, the economic landscape is always shifting, and 2026 could present a golden opportunity. So, if you're a homeowner, or you plan to be one soon, this video is your ultimate guide. We'll break down exactly what refinancing is, why you should consider it, and a step-by-step process to navigate it successfully in 2026. Stick around, because the tips we're about to share could have a huge impact on your financial future. First things first, let's demystify what refinancing actually means. In the simplest terms, refinancing is the process of replacing your existing mortgage with a new one. Think of it like trading in your old car loan for a new one with better terms. The new loan pays off your original mortgage, and you start making payments on the new one. People do this for several reasons. The most common one is to secure a lower interest rate. Even a small reduction, say 0.5%, can save you thousands or even tens of thousands of dollars over the life of your loan. It can also lower your monthly payment, freeing up cash for other goals like investing, saving for college, or finally taking that dream vacation. Another big reason to refinance is to change your loan term. Maybe you started with a 30-year mortgage to keep payments low, but now you're in a better financial position and want to pay it off faster. You could refinance into a 15-year or 20-year loan. Your monthly payment might go up, but you'll own your home free and clear much sooner and pay way less in total interest. On the flip side, if you're feeling a bit of a financial squeeze, you could refinance from a 15-year loan back to a 30-year to reduce your monthly burden. It's all about making your mortgage work for your current life situation, not the one you were in years ago. A third popular reason is to tap into your home's equity. This is called a cash-out refinance. Let's say your home is worth $500,000 and you only owe $300,000 on your mortgage. You have $100,000 in equity. With a cash-out refi, you could take out a new, larger loan, say for $350,000. You'd use $300,000 to pay off the old mortgage and get the remaining $50,000 in cash. People use this cash for all sorts of things: major home renovations, consolidating high-interest debt like credit cards, or paying for education. It's a powerful tool, but one you need to use wisely since you're borrowing against your home. So, now that we know the what and why, let's talk about the when. How will you know if 2026 is the right time for you to refinance? The first signal is, of course, interest rates. Keep an eye on the market. If the prevailing mortgage rates in 2026 are significantly lower than the rates you currently have, it's time to start running the numbers. A general rule of thumb is that if you can lower your rate by at least 0.75% to 1%, refinancing is often worth considering. Why? Because there are costs associated with refinancing, and you want to ensure your savings will outweigh those fees. We'll get to the costs in a bit. The second thing to consider is your personal financial situation. Has your credit score improved since you first got your mortgage? A higher credit score can unlock much better interest rates. Lenders see you as a less risky borrower. So, if you've been diligently paying your bills on time and have paid down other debts, you're in a prime position. Also, think about your income. If your household income has increased, you might be comfortable with a shorter loan term and a slightly higher payment to build equity faster. Or, if you plan on moving in the next few years, refinancing might not make sense, as you won't be in the home long enough to recoup the closing costs through monthly savings. Alright, let's assume the stars have aligned. It's 2026, rates are looking good, and your finances are in order. What's the plan? Here is your step-by-step guide. Step 1 is to know your numbers. Before you even talk to a lender, you need to do a financial checkup. Pull your credit reports from all three bureaus: Equifax, Experian, and TransUnion. You can do this for free. Check for any errors and dispute them if you find any. A mistake on your report could be dragging down your score. Also, calculate your current loan-to-value ratio, or LTV. You do this by dividing your current mortgage balance by your home's estimated market value. A lower LTV, ideally below 80%, makes you a more attractive candidate for refinancing. Step 2. Define your goal. What are you trying to achieve? Are you aiming for the lowest possible monthly payment? Do you want to pay off your loan as fast as possible? Or do you need to pull cash out for a big project? Knowing your primary objective will help you and your lender choose the right loan product. For example, if you want to pay off your house quickly, a 15-year fixed-rate mortgage is your target. If you need cash, you'll specifically be looking for cash-out refinance options. Being clear on your goal from the start prevents you from getting distracted by other offers and keeps the process focused. Step 3, and this is a big one, shop around. Do not just go back to your current lender. While it might seem easier, they may not offer you the best deal. You should get quotes from at least 3 to 5 different lenders. This includes big national banks, local credit unions, and online mortgage lenders. Each one will give you a document called a loan estimate, which breaks down the interest rate, APR, and all the estimated closing costs. This is crucial for comparing apples to apples. Don't just look at the interest rate, look at the total fees. A lender might offer a slightly lower rate, but tack on thousands more in fees, wiping out your potential savings. Step 4 is to gather your documents. The mortgage application process requires a lot of paperwork. Getting it all together ahead of time will make everything go much smoother. You'll typically need your most recent pay stubs, W-2 or tax returns for the last 2 years, bank statements, and statements for any investment accounts. You'll also need a copy of your current mortgage statement and your homeowner's insurance policy. Having a digital folder with all these documents scanned and ready to go will make you a lender's favorite applicant and speed up the entire process significantly. Step 5. The application and appraisal. Once you've chosen a lender and a loan product, you'll formally apply. The lender will do a deep dive into your finances and credit history. They will also order a home appraisal. An appraiser will come to your property to determine its current market value. This is a critical step, especially for a cash-out refinance, as the appraised value will determine how much you can borrow. It's important that the appraisal comes in high enough to support the new loan amount. If it comes in low, you might have to bring cash to the table or reconsider the refinance. Let's talk about those costs. Refinancing isn't free. You'll have closing costs, just like when you bought your home. These can include application fees, appraisal fees, title insurance, and attorney fees, among others. These costs typically range from 2 to 5% of the new loan amount. So on a $300,000 loan, you could be looking at $6,000 to $15,000 in fees. This is why it's so important to calculate your break-even point. This is the point at which your monthly savings have completely paid for your closing costs. To find it, divide your total closing costs by your monthly savings. If your break-even point is, say, 36 months, you need to be sure you stay in the home for at least 3 years to make the refinance worthwhile. And finally, Step 6. Close the deal. Once your loan is approved and you've reviewed and signed all the final paperwork, the new loan is funded. Your new lender pays off your old lender, and you're officially refinanced. Your new mortgage payments will begin, usually in the following month. Congratulations! You've just potentially saved yourself a ton of money and better aligned your biggest liability with your current financial goals. Looking ahead to 2026, being prepared and understanding this process is your best strategy. Start working on that credit score now. Keep an eye on the market, and when the time is right, you'll be ready to act. Thanks so much for watching. I hope this guide helps you prepare for a successful mortgage refinance in 2026. If you found this video valuable, please give it a thumbs up and don't forget to subscribe and hit that notification bell so you don't miss our future content. Got any questions? Drop them in the comments below and I'll do my best to answer them. See you in the next video.